Hi folks, Scott here, and this is the wrap for Friday, June 14th. Let me adjust the mic down a little bit. All right, interesting day here. It's middle of the day, but I'm having to do the video early, which is not a big deal because they're pretty confident we'll see, but I'm pretty confident we can predict what's going to happen today that generates a good test that's worth paying attention to going into the Monday. So to start things off, let me show you the results of fading gaps on Mondays when below the 20-day moving average but closed above the 200. So I'm fully anticipating it could rally, you never know, so this test will be negated. But I am anticipating, that we're going to close below, you can't see it, let me see, the 20-day moving average. Let me turn it on, which is at 1642. So if we close above 1642 on the cash index, the S&P 500, or about 11 points higher than we're trading now, which again could happen. If we do, then this test is you need to disregard. I ran some studies in the room though that showed end of day odds favor that if we were weak or below the open as of noon today, which is when I'm doing this video, then odds showed that we're more likely to sell off than to rally the rest of the day on a Friday. Okay, so with that in mind, let me show you the results. Fading gaps after closing below the 20 but above a 200 on a Monday. There you go. A couple things stand out. 2-to-1 odds on gapping up on a Monday after closing below a 20-day moving average on a Friday. However, the other thing that stands out is that going long is the way to go. This is a clear long bias, right? Using an end of the day stop, 20 to 26 down gaps would have been winners, making a nice profit where only 36 of 57 up gaps, shorting them, fading them, would have been winners, and the average loser would have been a lot bigger than the average winner, so you would have lost a bunch of money. So that's a clear long bias. Normally I stop there, but we were in the room and I shared the following, or I was curious about how it would work with MTG stops. Mondays are particularly notorious for not working well with an intraday stop because you tend to get all the volatility. So let me change this to 0.3 of the 5-day ATR, 12-point max, 5-point minimum on the ES. Watch how these numbers flip-flop, which 90% of the time they don't, 80% of the time they don't flip-flop significantly, but this is one where they did. Check that out. Down gaps are the most unattractive scenario. Only 12 of the, what I just showed you, 20 winners, only 12 you could have caught with MTG stop parameters. So you tend to get volatility on a down gap on a Monday when below the 20-day moving average, running stops about half the time, and then reversing. Where an up gap, almost all of the ones that do fill use with taking very little heat, meaning you would have survived with our MTG stop parameters. So you want to keep this in mind. A down gap, you might want to delay your entry if our gap guides are favorable, or if you have some other criteria that you use for trading the gap. And an up gap, I'll just pretty much trade that straight up, defer to our gap guides and other analysis in the morning. But I thought that you'd find that helpful and interesting going into next week. All right, for today, we ended up with about a 2-point, not quite a 2-point gap down in the ES, sort of a nominal gap. I don't mind trading the smaller gaps, but I want it to be a strong setup, and it really wasn't. It was just neutral today. Now, it would have worked. Let me show you the worksheet. So at a glance, looking at our worksheet, you can see gaps down that open between the close and the low across all 8 indices. Only just a dead neutral setup. 62% win rate, made a little bit of money, 1.1 profit factor, but that does not consider slippage, execution errors, no fills, and so on. So it's just dead neutral scenario. Now the UCO zone, which is a gap down inside the bottom of a green candlestick, was a little bit better, but not much. It was actually, I don't think any of the 8 met my criteria. So it wasn't bad, it just because there were really no bad setups either. They were all just real dead neutral. There were some unique patterns of play, and those did favor down gaps. Down gaps after a bullish outside day, down gap after a 10-day moving average up straddle, down gap after a widespread 7-day, or the widest range day of the past 7. Strong numbers favoring the gap fill. Normally that's enough for me to trade with, say, even a speculative trade if the gap guides are neutral and you have 3 strong positive patterns. But let me show you sort of what kept me out of play. Um, as I showed in last night's wrap, this particular pattern just neutral to slightly weak, but I further confirmed that these small and mid-sized, and I've shown this many times in the past, and I knew this off the top of my head, small and mid-sized down gaps on a Friday, pretty much in any scenario, are riskier than normal. And when you're closing sort of in the middle of a range, particularly risky. Decent win rate, but you don't make any money. So these small down gaps with occasional big loser just doesn't make money. So overall, neutral probabilities for the UCO zone, which is where we were gapping today. That means prior day was up and we were up in between the close and the open. Down between the close and the open. Mixed, even though it was mostly positive factors for down gaps. And not much of an opportunity. So I wasn't going to trade a down gap. Had we rallied and opened up in the UHC zone, I would have shorted it for a trade, but that's not what happened. So no trade for me. And you can see what's happened. We talked about this at length this morning. The range guys are really just, as someone described them, as mush today. That's not bad. That tells you that there's cross currents. There's mixed data. The market's not set up in a clear and compelling way based on history. So systems are probably going to be more muted, and price can get choppy and two-way and less reliable. And that's exactly what's happened today. We had a false breakout to the high side, broke above the highs, and then it got rejected. Some people talked about going long on a pullback, but I was running a study that showed, you know what, Fridays, down gaps on Fridays, when below a 20-day moving average, are particularly notorious for selling off. So some folks went short. Even I try to get short on a break of, where was it? Oh, on a test of the lows, I wanted to get short possibly at the open, or as it broke down, I was hoping for a little bit of a breakdown to get short at 27. My target was +3 and +6. It came down, I think it missed the +6, but it did sell off 5.5 points. So just narrowly, for all intents and purposes, did what I expected to do before it bounced. So I canceled. Some other folks did get short in the trading room because of the data I showed for end of day probabilities, and just a quiet day for me. So it's been that way of late a little bit, just waiting for the market to set up in a historically strong manner. So that was my day, and that is the wrap for Friday, June 14th. Have a good weekend.